Welcome to the Mike's Restaurant case study. The purpose of this case is to explore the dynamics of break-even, fixed and variable costing in a business, and to generally do some financial planning in the context of a business. And in financial planning, I mean exploring a budget for the coming year in order to achieve a certain profit level that you might set as a target. Mike's Restaurant is a case that uses a somewhat complex environment of producing many different products in the sense of different plates of food that are sold at different prices, and there's a volume component that determines how many of these plates that you sell. And you'll see in the case that we want to explore achieving a certain profit target. We want to understand the current and future break even of the business, and then what we want to do is create a plan where we can work towards achieving a profit target. So first thing up is let's give a quick overview of the case. I'm not going to spend too much time on this because really I want you to give it a read and take it in for yourself. But let's have a look at what's going on here. So we're talking about this fella Jake Long, who is the owner of the restaurant, and he's the manager, and he's doing some financial planning. And they talk about the plan to open additional facilities and expansion, etc., in the coming years. Further down here we see some information about, despite a 15-year track record, Jake has spent a large proportion of his time directly involved in the operations of his first restaurants, but he felt it's important for him to fully understand the financial operations of the business as opposed to only understanding the operations of the business. So this is obviously a financially based case. And there's some discussions here about how they want to manage these chains, etc., and how they want to manage future restaurants. But Jake really starts with the challenge here of wanting to determine the break-even point for the business, both under the current operating conditions and under some assumptions and changes that might take place in the future. And we're going to help him with those calculations, taking into account variable and fixed costs, etc. So we're given some important data here, and it relates to Exhibit 2, and I'm going to show you that in a moment. And really it's saying that there are some expenses, labor costs, direct and salary, that would rise by 10%. So they're telling us about how the future costs are going to change. They also tell us here that the cost of the raw materials, in other words the food that we buy from our suppliers, is expected to go up by 20%. So we need to use that in our forecasting. And then finally, all other costs, including payroll, taxes, etc., etc., exceptions and so on, I'll leave that to you to read, will go up by 10%. So that's very important for our future planning of this business, and we'll come to that in a moment. So let's scroll down here, and we're given some financial information for the 2011 year, which is if you want, the previous year to where we are at the moment. We are going into the 2012 year, and in Exhibit 1 we are provided with financial information that would typically come from an accountant. Obviously there's a sales number at the top, and here the accountant has referred to direct labor and food costs in the cost of sales, calculated a gross profit, and then listed a whole lot of different expenses in here, some of which are fixed and some of which are variable. there's the total expense, subtract that from the gross profit, you've got a profit before interest and tax. Take out some interest and you've got a profit before tax. And you'll see here that there's no tax that we are considering in this example. So what they have very kindly done for us in this case is they've taken the data from Exhibit 1, which is an accounting data, they've put it into Exhibit 2, where they've revised the data for the operations. So notice that the sales are the same, but in this case, instead of having cost of goods as they had in Exhibit 1, we now have variable costs. In other words, all of the costs in the business that are variable have been neatly consolidated here together, and we have a total cost for those expenses. And below that, all of the costs that are fixed costs have been put together. These percentages here are an indication on how some of the costs are split between variable and fixed. So let's take, for example, the direct labor cost, which in Exhibit 1 is 175,653 Rand. Now it's been determined that of that total cost, 80% of the expense is variable. In other words, it's linked to the production of product, and the remaining 20% is fixed. Alright, so that's what Jake believes is the circumstances for this business, and therefore that is how he has split these costs. It makes sense that the entire food cost is variable. In other words, the more food that you produce, the more food you sell. And then these remaining percentages work in the same way. 85% of the laundry cost is a variable cost, and the remaining 15% is a fixed cost, and so on. So that's what these percentages mean, and what we have here is a set of financial information for the income statement that in fact is far more user-friendly than what the accountant has provided us with. Now, given that we have this information, we are going to move on and answer some questions. And question 1 is saying, calculate a break-even for the current year. Alright, so you're going to apply your information that you've learnt in order to do that calculation, and then it asks you what is the break-even figure for the coming year. Alright, so this is where it gets a little bit tricky, because we don't have an income statement for the coming year. That means you need to construct it. And how do you construct it? Well, you take the information from Exhibit 2 and you do a forecast for the coming year. And how do you get all the data for this information here, these expenses that are going to change? You come to the second last paragraph and you take out this information here, the 10%, the 20 and the 10, and you apply it in order to find out what will these expenses be in the coming year. For the purpose of your forecast, assume that the sales remains unchanged. That will help you determine what the margin in the future will be if your expenses go up. Alright, so that will help you to calculate the break-even for question 1. Question 2 is a little tricky, and it will require us to spend a bit of time together discussing this. The principle of question 2 is as follows. We want to create a profit of 115,000 in the coming year. There's a few ways that we can do it. We can either increase the selling price, or reduce the variable costs, or reduce the fixed costs. What this question is testing is, what if we do each of these things one at a time? What would the forecast look like? And this is to help us understand how these variables impact our profitability one at a time. Question 3 is saying, in this case, we want to achieve this profit of 115,000, and the way we want to do it is not by changing any of these variables. We just want to increase the volume. So it says here, no changes to the sale price. We just want to sell more food. Okay, so in fact, between question 2 and question 3, we are going to create a scenario where we test 4 different variables: changing the sales price, changing the variable costs, changing the fixed costs, and changing the volume. And we are going to do those all independently. And then we get to question 4. Question 4 says, right, let's combine all of what we've learned in question 2 and 3 and find the ideal scenario, the ideal means of making 115,000 Rand in profit. And in this case, it's probably increasing the volume by some proportion, increasing the selling price by some amount, reducing the variable costs by some amount, and reducing the fixed costs by some amount. And that combination of all of those will have an effect on the profitability for 2012 and how best do you achieve this. Alright, so have a go at it. Good luck. And in the following video, or maybe videos, you will be able to explore the answer, and hopefully it will develop some questions in you about this financial planning of this business. All the best, and see you in the next video.